Hello, everybody. Thank you for joining me today. It's Allan Laboucan with the Rocks and Stocks News Show. Today, I'm going to be reviewing the Outlook 2025 report as we are now at the end of the first quarter and talk about the metals and other stuff in there. We're going to take a look at it. I'll probably make some comments along the way. As always, if you want to get on my email list and receive my reports as they're published, you can go to that Substack up there at rocksandstocks.substack.com. And on that note, let's get started. I'm going to share my screen. And there you go. In 1 second. There it is. Okay, so I gave it a fancy title of Rocks and Stocks News Outlook 2025 and got right down to business with gold. In that, I said gold is in the earliest days of a renaissance as investors in the West and central bankers in the BRICS nations and others are loading up on gold. They have come to terms with the fact that the debt and fiat currency system is broken. Those in the West have yet to come to that reality that there is a death spiral of debt and relentless devastation of purchasing power of their fiat currencies, which is causing massive problems that will require a rebuilding of the entire economic system, with an emphasis on gold being the foundation. These issues started when Nixon took America off the gold standard in 1971, which allowed politicians to create debt with no meaningful restrictions, and they cranked up their fiat currency printing press to devastate the purchasing power of the US dollar. It is still the world reserve currency, but gold looks to take a run at it as it has surpassed the euro to become the second leading reserve currency. I'll add in there that uh, in 2024, gold surpassed the euro as a reserve currency, and the US dollar has dropped about 10% of its position as the world's reserve currency. I went on, investors in the East and central bankers in and outside the BRICS alliance are on the path to putting themselves on a modern version of the gold standard. They were forced into it after the 2008 global financial crisis as they realized they held too much US debt and US dollars. This started them on the path of divesting their holdings of the US debt and US dollars. Then in 2022, 2023, and 2024, they amped it up and went on a gold buying spree. Gold's performance has been driven by a combination of the death spiral of debt and central bankers in the BRICS alliance buying, with Trump winning the election and having proved he loves to create debt. The reasons to be bullish on gold are in place for 2025 to rival 2024 by setting a new series of record highs. My speculation for 2025 is that gold will reach the $3,500 to $4,000 range this year. On that speculation, I wouldn't change it at all. In fact, I would add to my confidence on the $4,000 side of that range. And let's take a look at gold to get an idea of just how powerful it has been over the last year or so. As you can see, it's gone from the lower left of the chart to the upper right. Along the way, it set a series of record highs. And in 2025, it finished 2024 at about 26.33 and is up almost $400 per ounce since then. This is the futures chart, by the way. And along along the way, uh, what's really come into focus in 2025, in addition to the drivers of the debt situation and the cost of servicing that debt, which is now at about 25% of the revenue that comes in from taxes. This is an unsustainable situation. and that has been the main driver of gold. But I think that a couple more drivers that have come into play are stagflation, which I've been talking about for several months. And I think it's becoming clearer to more folks. I'm seeing more talk about it, that people are starting to realize stagflation is likely to get worse in 2025. And I think later in this report, I talk about some of those reasons. So let me keep going. The next topic on the on in that Outlook 2020 report, 2025 report was silver. Silver has remarkably bullish fundamentals. It is a monetary metal like gold, but has not really entered into the gold bull market yet. Gold made several new record highs in 2024. Silver is still a long way from its record high. This is in itself a powerful argument that gold is still in the earliest days of a bull market. In every past gold bull market, silver joins the party and starts significantly outperforming gold on percentage terms. This has still not happened. It is somewhat surprising that silver has not yet joined the gold bull market party, as it has been in a supply deficit for the past few years, a very big one, as physical demand has been around 200 million ounces more than the physical supply. Key drivers of the deficit are that mine supply has been unable to increase, while demand has been very powerful from solar panels that are getting cheaper and a very good alternative energy source in several jurisdictions. I live in Mexico, and it is a great source of energy where the sun's out all the time. And like on the top of my roof, I have a water heater, and it's powered by solar, and I see solar panels everywhere throughout Mexico. I then went on. One of the reasons people feel that silver hasn't been stronger is because investors are looking at it more as an industrial metal than a monetary metal. The deficit has been filled somehow, but is unlikely that it can last much longer. Silver production from mining is around 800 million ounces per year, and with a 200 million ounce deficit for the past few years, silver is ready for a massive move. The bullion banks are the likely source of the supply that has filled the deficit, but they must be running that down to critically low levels. They are putting themselves in a precarious position with so much paper derivatives trading with diminishing amounts of physical silver to back that up. At any point now, I could see us wake up to the beginning of a tremendous bull market for silver, and it's at it as it has one of the best setups I have ever seen in any metal. And I've been in this business for over 30 years. My speculation on the price of silver is that we will see it get well above $40 per ounce, with a chance it could take a run at its record price. So let's have a look at silver. And so it's been on a very good run so far in 2025. It ended the year at below $30, let's say 29.40. And today the futures are trading at 34.77. I love seeing charts where the bottoms on the pullbacks are rising. And as you can see, since this low here at the end of the year, higher high, higher low, higher low, higher low, higher low, higher low. Very bullish trend. And you're seeing the same on the highs, higher highs, higher highs, higher highs, higher highs, higher highs. I think that this is much like what we saw in gold back here when it broke out and then had a phenomenal run for the last year or more. And I think we could see the same thing happening, the start of it in 2025 here, as it's in a very strong channel with those higher highs and higher lows. All right. So then I went on in the report, copper. Copper is the most critical metal in our electrified world. We constantly hear about alternative energy, the need to rebuild aging power grids in developed economies and build new ones in developing economies, electric vehicles, artificial intelligence, and many other things that need massive amounts of copper. What we hear less about is where all that copper is going to come from to make all of these things work. For the past couple of decades, new discoveries of important copper mines have fallen off a cliff. Most of the copper mines being depended on now were discovered in the 1980s and 1990s. It takes 15 to 20 years to find a copper mine and bring it into production. The supply chain is broken precisely when it needs to be perfect in order to meet the near-term and long-term demand. It isn't, and it won't be able to, which will drive the price of copper multiples from its current price. Higher prices will help spur more exploration and new mine development, but it won't fix the problem. It still takes massive amounts of drilling, years of economic studies and permitting, then billions to develop them and bring them into production. People may want to turn on the switch for all the electrical products, but turning on a copper mine is much more difficult. Every major mining company has a hunger for more copper mines in their portfolios, but due to the decline in copper discoveries over the past couple decades, the copper cupboard is bare. The broken copper supply chain is very bullish for the price of copper. My speculation for 2025 is that copper gets into record highs above $5 per pound and stays there for the foreseeable future. Got this one pretty correct. Let's take a look at copper. And as you can see, in 2025, it was closed 2024 at slightly above $4 per pound and has been on a heck of a run in 2025, trading all the way up to a new record high on the futures price of about $5.37 per pound. And it closed today at $5.05 per pound. So I think that this $5 level is going to become the new support level, and that we spend the rest of 2025 with gold or copper well above the $5 level. So got that one pretty correct, as I did with gold and silver. Okay, so now then I went on to gold, silver, and copper stocks. Gold is on its way to resuming its important role as a key reserve currency and the key to fixing the unsustainable growth in debt and devastation of purchasing power of fiat currencies. The economic world is on a path to a modern gold standard. Countries and investors that understand what is happening and are prepared will be well positioned to protect their wealth and their purchasing power. We are still in the earliest days of backing up the failing debt and fiat currency system, and as more countries build up their reserves of gold, then we will see a transition to gold resuming its past glory as a key currency for international trade. It's the soundest money by far. The powerful trend in gold during 2024 has been very good for the best in breed gold miners like our top gold miner picks, Agnico Eagle and Alamos Gold. They have significantly outperformed gold and most of their peers. So far, only the big gold miners have joined the gold bull market. The same thing happened in the 2001 to 2011 gold bull market. First, the major gold miners moved, then the mid-tiers joined in, followed by the new mine developers, and finally the explorers with important discoveries. The gold bull market hasn't really moved down the food chain yet, but 2025 is primed to be the year that it does. I'm going to do a follow-up show on a report that I wrote about 6 weeks ago that shows a series of charts of companies from Agnico Eagle, Alamos Gold, other gold miners, gold developers, that had significant breakouts since they had their lows in December of 2024, or from where they closed 2024 at. So I'm not going to go into gold charts in this show, or gold stock charts, but I will be following up with the report in the next few days about those breakout stocks. I also expect to see silver and copper stocks join the gold bull market as well. When it comes to new mine developers and explorers with important discoveries, there is a very tiny menu for investors bullish on silver and copper to choose from. They are rockets ready to blast off. Over the past several months, I've been doing a lot of deep dives into projects of companies that I follow closely. The goal of this work is to prepare myself to do a series of deep dive video reports starting in the next few days. You can find those on either my rocksandstocks.substack.com or go to my YouTube channel at Rocks and Stocks News. Just do a search for Rocks and Stocks News and you'll find those. I've been going over drill holes, maps, scientific papers, technical reports, and discussing projects with geologists and company executives. My mentors in geology, geochemistry, and geophysics have helped me over the years to be able to take highly technical information and present it in a way that investors that aren't geologists can appreciate. The reason I do that is most investors in gold, silver, and copper stocks are not geologists, and yet I find a lot of news releases are like they're written by geologists for geologists, and so I try to break that down for my audience. A couple of themes that I will be discussing in this series are where a company is in the Lassonde curve, as well as where they are in a gold, silver, and copper system. These topics are very crucial, are key to the work that I've done over the years. And again, I don't make the gold, silver, and copper system too complicated. In fact, I do everything I can to make them as relatable as possible to investors, not to to geologists. Understanding these topics are a great way for investors to better understand the value proposition in a particular company. As I have been doing my prep work, I have been overwhelmed at how much unlocked value I'm finding in several gold, silver, and copper projects. With gold, silver, and copper trading the way it is, I never thought I would see the prices where they are and be able to find so many companies to talk about, because I think that there's lots of unlocked value. And yet that's where we are today. And I've written recently about investors like Warren Buffett and others like him talk about swinging at fat pitches. Um, and there really has never been a fatter pitch when it comes to gold, silver, and copper stocks, because, they're two of those three are trading at all-time highs, and yet the stocks are still being valued like they're in a bear, those metals are in a bear market. So, that's a once in a lifetime type of a fat pitch in gold, silver, and copper stocks. And so I have been writing about that. Now, another topic that came up for me during 2024 is digital marketing for miners. In addition to being convinced that there has never been a better time to be bullish on gold, silver, and copper, there has also never been a better time for miners to promote their projects with some of the great digital marketing tools at their disposal. The mining industry has a terrific story to tell and broadcast across the digital airways. Without mining, nothing in our modern world gets made or operates. Although the mining sector is crucial for everything, It doesn't get much help from the financial media and brokerage industry, which puts the industry in the position that it has to take the storytelling bull by the horns and tell the story of how important in mining is to the modern world. Fortunately, the tools to do that are available like never before. Investors are on X, formerly Twitter, and YouTube, consuming content and networking to learn more about metals and mining stocks and then promote them to each other. I'm seeing more and more mining companies that are embracing the digital marketing tools to help spread the word about the metals they are involved in and what their companies are doing to unlock shareholder value. This is a welcome trend, and I think it will only pick up momentum. Another reason that I'm so bullish on mining companies more aggressively using digital marketing tools are the analytics that the best websites provide. In advertising, a well-known saying is half the money I spend on advertising is wasted. The trouble is I don't know which half. That is certainly not true for print ads and that is certainly true for print ads and television ads, but not true when it comes to digital marketing tools, as they have back-end analytics to track all the key engagement statistics. It is also true that for a traditional marketing method that mining companies have used for many years, which are mining conferences. A couple of days ago, I heard a great comment from a young mining executive. He said that he's only going to mining conferences that also provide video coverage of his presentation. His reasoning was that he has plenty of great one-to-one meetings with investors when he goes to mining conferences, but is unsure of how much value that has for the money he spends. He added that if there are videos of his presentation, then they can be consumed by many investors. It was music to my ears because I've been trying to get that exact message across to mining executives for many years. His company has a great project, and he does plenty of online interviews and can see the benefits from that in his stock trading, stock valuation, and trading volume. I hope more mining executives come to the same conclusion. The mining sector is crucially important as it provides the raw materials needed to make everything in our world, modern world. Plus, there are very compelling bullish arguments for metals and for the companies exploring for new discoveries, developing new mines, and mining metals. Miners have a tremendous story to tell, and it makes me happy to see the industry more effectively using digital marketing tools to tell their stories. It will ultimately help the industry draw the attention it deserves for mining metals and their companies. I just wanted to highlight something that is a bit of an inside baseball. I not only have produced a lot of my own videos over the years, but I've also consumed a lot of videos over the years. And one of the things that I think people get wrong when they're looking at the analytics for a video on YouTube is that they are very focused on the viewer counts. They think that by having thousands of views is more of getting across to more people. But what I try to make company executives aware of when I'm talking to them about this topic is that a lot of times those views can be bought. And they're bought by bot farms that basically cause the play button to be clicked and then quickly bounce out and leave the video. And so what that does is, yes, you can get these really high viewer counts, but then if you look at the back end in the analytics that YouTube provides, you will find that the average view time per a viewer is very low. I'm quite proud of the fact that, the average viewer of my shows watches about 40% of the entire long form video. And I've done a lot of research on this topic, and when it comes to videos, not the ones I do, but videos in general on the internet, to get 3 or 4% um, uh, view percent per viewer is very high. So to get 40% average view times per video I put out is a sign that the viewers that are following my stuff like what I'm talking about, and they're interested in mining stocks and metals and that sort of stuff. So if I had to give advice to mining companies, don't pay attention to the view counts. Those are easily manipulated. Where the real guts and the real crucial information is in the analytics behind YouTube. And if you're sponsoring content creators, ask them about their back end YouTube analytics. Those engagement numbers are really, really important. All right. I had my little rant there. So next I talked about politics, interest rates, stock market, Bitcoin, BRICS, and the US dollar. I did mention that in my 2024 year in review report, I linked to it. I wrote about why I think the above topics are bullish for gold. So you can find that on my Substack at rocksandstocks.substack.com. Okay. So on the politics front, I don't like to, I mean, politics and money are married. That's why I follow it in my reports. And this one I said, where debt goes, so will go gold. Trump made a lot of campaign promises to get elected, but keeping them will be an entirely different matter. His key advocate, Elon Musk, has talked a lot about out of control spending that could bankrupt the country. It actually is. He is right, but getting politicians, including Trump, to slash spending is an insurmountable hurdle. Politicians on the left and right love spending and growing the debt, which is why the debt to GDP ratio is so alarming. It's actually at what you would think of, third world countries kind of stuff in the biggest economy in the world. And sort of confirmation of this analysis is that, since President Trump got in, the GOP controls the House and the Senate, and they voted recently for a continuing resolution that they are going to increase the debt to 40 trillion, and they kept all of Biden's spending for the start of President Trump's. So they haven't slashed anything. I went on, America is the biggest economy in the world, but it also has a debt to GDP ratio climbing at an alarming rate and at a level that is in the past was reserved for basket case economies. It's currently sitting at about 125%, or I think it's 127% of debt to the GDP. That's unbelievable for the world's largest economy. Much of the spending is ingrained in the system. Medicare, Medicaid, Social Security, interest on the debt, and defense consume more than what comes in from taxes. They are untouchable. You try to cut Medicaid, Medicare, Social Security, or defense, and you're going to get voted out of office really quickly. The interest on the debt is a product of the debt and the interest rate, so can't do much about that other than to try to cut spending, which they haven't done with this new continuing resolution. Everything else the government spends money on pushes the deficit to over 2 trillion. Those expenditures are how politicians pay off their financial supporters and how they get rich in office from kickbacks. Politicians on the right, left, and right will fight tooth and nail against cutting any of that spending and will have nothing to do with slashing them. We saw in the recent funding battle to keep the government running, they cut down the pages in the initial huge bill that had bipartisan support. These Democrats and Republicans, they don't agree on anything, but they did agree on the spending bill while keeping all the spending. So they didn't cut the spending. Even more telling about the spending bill that will happen during the next administration is that Trump wanted to eliminate the debt ceiling. He was and is a debt junkie, and that certainly hasn't changed. He will cut taxes without a plan to pay for them, only hoping that they will trickle down to economic growth. It didn't work for Trump in his first term, other than to widen the gap between the rich and everybody else, and it won't work in his second term, other than to drive the debt higher. He also wants mass deportation, while the economy needs the cheap labor from immigrants to keep it together. If he goes ahead with this plan, which he has, which his MAGA crowd is demanding, he will slow the economy, which he has, when it least needs it, which is now, and also drive up inflation, which is also happening. Elon Musk and his fellow tech bros also need cheap labor from the H-1B visas to keep their costs down and profits up. Musk's support of importing tech workers while deporting others is a topic that is boiling over and will cause a huge chasm between his fellow tech bros and the MAGA crowd. That has somewhat been tempered, but it could blow up at any time. Trump talked tough about tariffs before and after the election, but if he goes ahead with them, which he is doing as of tomorrow, or Tuesday, April the 2nd, he calls it Liberation Day, when he plans on sweeping tariffs on practically every country that the United States trades with. Another campaign promise the MAGA crowd love. But it will cause more inflation. He may be able to fool voters into believing that foreign companies pay the tariffs, but the reality is that they pass those on to the consumers that want to buy their products. In addition to causing inflation, it will also slow down the economy when it is already on shaky ground. And that has happened, which is why the stock market has been under pressure of late. I'm going to go to that later. The bottom line is that Trump will spend like never before and likely run the debt up to 50 trillion by the time his second term ends. I think that's a given. Most don't. The CBO predicts that that's going to take until 2035. I think it's going to happen before 2030, plus cause another wave or two of inflation. I think we're already seeing that. He said that America has headed toward a golden era, and that he will be proven right as his policies drive gold much higher, as we've seen so far in 2025. Okay, then I went into interest rates. Bond vigilantes are okay. Let's first go. Okay, no, I'll go to the stock trends later. Interest rates. Bond vigilantes are worried about a second wave of inflation as they are on a buyer strike and driving yields up. Let's go look at that while I'm here. So here's the 10-year. And as you can see here, they went under serious pressure, which drives the yield up until early 2025. They've had a bit of a dead cat bounce, which has driven the yields lower. But I think this is the start of another drop in the price of the of the bonds that drives the yields up. Okay, so let's go back to the report. Meanwhile, Powell is saying the economy is great, the jobs market is great, and their interest rate policy is great. Voters don't agree with Powell as they showed up on election day to voice their displeasure with the jobs, the economy, and inflation. As the old saying goes, it's the economy, stupid, and that was proven right in the last election. Voters and the bond vigilantes have it right. They have plenty of reasons to be concerned. Even the Fed policymakers are predicting that the economic growth will be significantly lower than inflation. Months ago, Powell said he doesn't see stag or inflation, but if you pay attention to their forecast for economic growth and inflation, they are making the case for stagflation. In fact, that's come out over the last couple of Fed meetings since this Outlook 2025 report. They now predict the Fed that the growth will be less than 2%, around 1.7%, and they're predicting that inflation will be over 2%, their target rate, and around 2.7%. So they don't say it, but they're actually predicting 1% of stagflation. Now, consumers, this has come out just recently. Consumers, and this bears out regardless of their political affiliation and their demographics, and also it's coming out with the corporate America that they see a potential for a recession, so closer to no growth or dip into a recession. Well, they're predicting 4% inflation in 2024, and their 5-year outlook is for about the same. So, the consumers, regardless of their political affiliation and their ages and their other demographic issues, plus corporate America, are talking about, 3-4% of stagflation. The last time there was stagflation in America in the 1970s, it was very bullish for gold, and it will be again, silver as well. The real economy is much softer than the government statistics suggest, and combined with Trump's policy, it is likely to slow down to well below the target rate of inflation, which means the Fed will have to accept higher inflation and lower rates to spur economic growth. They've either got to throw the economy and the stock market under the bus or inflation under the bus. And I believe they will throw inflation under the bus. This won't be easy because the bond vigilantes aren't cooperating. I see a few factors coming into play on interest rates in 2025. The jobs market and economy are going to need lower rates to keep them from declining into a serious recession or troublesome stagflation. In order for the Fed to keep cutting rates, they will need to get back into the QE business for two reasons. One is to manipulate the yields down, and secondly, as the bond vigilantes stay on a buyer's strike, the buyer of last resort, which is the Fed, will need to get in and buy. I suspect we will be hearing more about stagflation and quantitative easing in 2025, likely in the first quarter of the year. This will put wind behind the sails of the gold bull market, and boy, did I ever get that right. Back when I wrote this report and for the last few months of 2024, there wasn't very much talk about stagflation. But in the last month or so, I'm starting to see it on CNBC and other financial media. More analysts on Wall Street are talking about it. Economists are talking about it. Stagflation is real. I think it has been going on throughout most of 2024. I believe that the economics number understated the inflation and overstated the growth. But I think it's going to get more troublesome, and more and more people are going to be talking about it, which has happened right on schedule in the fourth first quarter of 2025. All right, the stock market. Let's pull up the stock market charts before I start talking about them, just so you get a sense of if I got this stuff right. So here's the Dow Jones Industrial Average futures market. As you can see, it started the year out with a pretty healthy run to around 45,204, but recently it has been under pressure for most of February and March, with a little dead cat bounce here and then more downside. S&P 500, little more pronounced that it was going sideways for December, January, and about the first half of February, but has since taken it on the chin, had a dead cat bounce, and has continued the downward pressure. NASDAQ is in more trouble. It had a sideways action for most of January, part of December, and part of February, but it has gotten pummeled of late. It did have that dead cat bounce and is also under pressure of late. And this is a lot to do with the tariff talk and the upcoming, what Trump calls Liberation Day. This big move down here a few days ago was when Trump was talking about or implementing 25% tariffs on auto sale or on automobiles made outside of the United States, and that also affects parts that are made out of the United States. So even though a lot of the American car makers assemble everything in the United States, they also import a lot of car parts. And shockingly to me, he even said that he could care less about if car prices go up. So he's basically saying, I don't care about the car companies. I don't care about the workers that make those cars. And I don't care about the consumers having to pay more if the car prices go up due to tariffs. Just unbelievably ignorant of the effects that his tariffs are going to have. 25% tariffs on car makers and importers and car and the parts that go into American-made cars. And so I think that this correction in the stocks is far from over. But let's look at what I said on January 2nd. The S&P 500 is priced for perfection, and the risks of a correction or prolonged market with a bearish bias are high. Boy, got that right, looking at those charts. Executives running the Wall Street stocks see the writing on the wall, which has been why they have been selling aggressively into the strength. Warren Buffett has also been selling to build up the highest cash position he has ever had. In a market that is trading at a huge premium, he is unable to find value opportunities. He can't even bring himself to buy his own Berkshire Hathaway stock because he sees that trading at a premium as well. While Wall Street executives and Warren Buffett are sellers of their own stocks, the rest of the market, well, Warren Buffett's not selling his Berkshire Hathaway, but he is building up cash and not buying his Berkshire Hathaway. So I think that's the Wall Street executives definitely are. The rest of the market participants keep driving valuations higher to valuations that are present prior to corrections and subsequent to January. We've seen those corrections. The only reason that I'm not arguing for a steep correction, when I say a steep correction, like I mean over 20% and a prolonged bear market, is because I doubt the Fed will throw Wall Street under the bus. Nonetheless, the risk of downside are much higher than the prospects for significant upside. Whoa, that was an understatement. At worst, there will be a serious correction in the stock market in 2025. 10% plus is we're there. At best, it will, and at best, it will be a choppy in a sideways market with a bearish bias. I think the latter is more likely than the former. So again, I don't see a 20, 30% correction in the Wall Street stock market because I think the Fed will come to their rescue on their third unspoken um, uh, what they're supposed to cover, which is price stability, wage, and also the one they don't talk about is supporting Wall Street at all costs, and that is the third mandate, and I think it is an important one to be aware of. So, although we have had a correction, uh, it hasn't slipped below that 10,000 or 10%, which would put it into a bear market. I think it could, but I don't think that bear market will, drop down to 30, 40%. I think we'll stay in the bear market for probably most of 2025. Then I talked about Bitcoin. Let's see. Before I talk about it, let's pull the Bitcoin chart up and see how it's done. So here's Bitcoin. And as you can see, it's been in correction since late January. After topping out here on let's call it the Trump bounce, that people were believing that there would be a Bitcoin reserve and the United States was going to go and buy a bunch of Bitcoin and drive the prices up. So it got it up to that 110 level. But since it topped out there, it's been in a pretty serious correction and has touched 80,000 twice. Had a bit of a dead cat bounce here, but is in another serious down leg as of late. So let's see what I said about it on January the 2nd. Bitcoin is a Ponzi scheme wrapped up in a mania. It is reminiscent of the dot-com bubble before it burst. We will know the Bitcoin mania is over when it trades below the average cost of mining it, which is around 75 to 80,000 per Bitcoin mined. And when it trades below the average price that buyers paid since the Bitcoin ETFs came out, which is around 65,000. So let's go back to the Bitcoin chart, and I got to spread it out here. Let me go to a weekly chart. So this was the ETF bounce, and as you can see there, it averaged somewhere around 65,000. Lately, I've been writing that I think this correction will fill the gap down to this level, and if it doesn't hold support at 65,000, I could see it filling the gap all the way down to 20,000. Okay. Okay. While all the Bitcoin bulls believe it can only go up to millions per Bitcoin, and Michael Saylor, its biggest pumper, says sell everything you have and borrow whatever you can to buy more Bitcoin. Oh my gosh, I sure hope people didn't do that at 100,000, but I'm afraid they did. I see that there is a potential for it to implode. What Bitcoin bulls don't seem to understand is that it doesn't come from the Bitcoin factory in their fantasy land. The backbone of the system are the Bitcoin miners that mine to make new Bitcoins and also process the trading transactions. It really doesn't, it isn't used as a to buy things. It is used somewhat for a very small amount of buying, but most of it is about trading transactions. So they mine for the Bitcoins and also to process the trading transactions. If the price of Bitcoin goes below the average cost of mining, then the high cost miners are in trouble. If it goes well below the average cost of mining, then the entire system breaks down and the price crashes. Bitcoin recently topped out at over 100,000 per Bitcoin, and it looks like the bubble could be ready to burst. Bitcoin and other cryptocurrencies have pulled investors' attention away from gold, silver, and the stocks in those metals. In 2025, I expect to see those trends reversed. I think it's fair to say that is happening now. All right, BRICS. Central bankers in the BRICS nations want to own less US debt in US dollars, while also want to own more gold. They are concerned about the weaponization of the US dollar and want an alternative to it that gold is perfectly suited to be, not only as a reserve currency that is the soundest money, as it has nobody's printing it, as it has nobody printing debt and fiat currency around it. Plus, it used to play an important role in international trade. And once they get their gold reserves high enough, it will again. I think that's happening as we speak. Their actions to load up on gold is a clear sign that they aren't fond of the entire debt and fiat currency system. I don't blame them because it's broken. I actually said that. Nobody can blame them because debt is in massive supply and fiat currencies are constantly destroying purchasing power. Gold is at record highs against every fiat currency precisely because it is the soundest money and has been doing its job to fight inflation and protect wealth. Investors in the East and central bankers in and outside the BRICS nations see the writing on the wall, and it is a when, not if scenario when investors in the West see it as well. And in the latter part, second half of the first quarter, I believe that is happening. The BRICS nations have been buying gold aggressively over the past few years at record levels, and everything is in place to see them continue that trend in 2025. I mean, basically, my arguments are just getting stronger. The death spiral of debt is continuing to get worse in the United States and throughout the world. The cost of servicing that debt is troublesome. In the United States, it's 25% of what comes in from taxes. And so that's unsustainable. And then stagflation. I think that this is a real driver of gold in 2025. Okay, U.S. dollar. The U.S. dollar. Okay, let's go look at the U.S. dollar before we get into it. Okay, futures. All right, U.S. dollar. Okay, so it had rallied from October or late September through to early January and has been under pressure since. This doesn't surprise me at all because Trump wants a lower US dollar to improve the trade imbalance. The US dollar is cheaper or lower, then countries outside the US can buy American made stuff. If it's strong, they can't. And then you got this deficit between exports and imports. And so he wants a lower dollar. Some believe that his tariffs, mass deportations are an effort to tank the economy and the stock market to force the Fed to lower rates. If that's what he's doing, lower rates will mean the dollar will continue to be under pressure. If that's what he's doing, that's a very risky gamble. But as you can see, it's been under pressure for pretty much all of 2025. So what did I say was going to happen on January 2nd? The US dollar index has been on a run since before the election when it was trading in the same direction as yields. And then it went into overdrive after Trump got elected on the hopes that his policy will be bullish for the US dollar, even though he talks about wanting a cheaper US dollar. Now the US dollar index is looking extremely stretched and ready for a significant correction. Wow, I got that pretty on the money. As I discussed in the section above on the Fed, I think they will need to cut rates to protect the economy, the job market, as well as Wall Street, and ultimately get back into the quantitative easing business to protect the bond market because the bond vigilantes are on a buyer strike. None of these issues will be bullish for the US dollar, and it is heading for rough waters in the early part of 2025 and throughout the year, which is another bullish argument for gold. And as you can see in the chart, I got that pretty bang on the money as well. In closing, as I was writing the 2024 year in review report, it struck me as to how many bullish factors are in place for gold's performance to rival 2024 in 2025. And boy, it's actually exceeding 2024 in the early part. When I add it all up, there has never been a better time to be bullish on gold, and I have made some of the arguments about why I think gold could do even better in 2025 than it did in 2024. I would add here that it's definitely started 2025 that way. Even more compelling are arguments to be bullish on best-in-breed gold miners, developers with high-quality gold mines, and explorers with important discoveries. Now, this has happened, and I highlighted this in a report that I talked about significant breakouts. And the next show, or I'm going to do a show within the next few days where we look at that report and the companies in that report. So I don't want to go into that one in this show. This show is all about going over my predictions that I made in the 2025 or Outlook 2025 report. I'll leave you to give me the grade on it, but the evidence is there of what I said and what's happened since. And that's up to my readers to give me a grade on that. But I'm pretty happy with what I'm seeing so far on all the predictions I've made, and I wouldn't change any of them. So there you go, folks. That's my this report. That is a quarterly report that I'm going to do each quarter from now on. So I did the Outlook 2025 report, and then at the end of each quarter, I'll do these reviews, quarterly reports, if you will. And as always, I really I'd like to invite you to if you're not on my email list, just go to rocksandstocks.substack.com. If you like watching my videos, they're also posted on the Substack site and sent to through email. But you can also subscribe to my YouTube channel at Rocks and Stocks News. Just do a YouTube search for Rocks and Stocks News, and you'll find my channel on YouTube. And as always, I am not making buying or selling recommendations. those decisions are up to you to do your homework, speak with your financial advisors. I try to be an idea generator, and I try to present my opinions based on my 30 plus years in the mining business. I've been a reporter on the industry for 20 years. I publish everything. All my reports are there for people to see. That makes me a lot different than a lot of my peers. And It's because I get it right a lot. I get it right a lot more than I get it wrong. And I want everybody to be able to do their research on what work I put out there and my opinions. But again, that is just as an idea generator. I have my, uh, whether, like I take sponsorships to help me produce this work that I do. And I always say that whether a company is a sponsor or a pick, I treat them all the same way. They have to go through the same filters. But I also want to say something about my biases. Okay. I'm biased like every person that has an opinion on any topic. I want to be right. I don't put these speculations and reports and of what I see happening because I want to be wrong. My biggest bias, and one you should be aware of whenever you read my reports or watch my shows, is that that is my ultimate bias. Whether a company's a pick, a sponsor, or I make speculations on the direction of the markets, currencies, metals, gold, silver, copper. My biggest bias is I want to be right. Okay. So there, I think I dealt with my biases. So, but again, do that homework, speak with your financial advisors. I'm giving you my opinions, and I don't know how your risk tolerance. This is just my views on things. Do your homework, speak with your financial advisors. Have a great day, and we'll talk to you soon.